Before we start this video, do like and subscribe to our channel and not miss on any updates.
So today I'm going to cover about 7 case studies relating to CA final AFM in IBS. And these case studies, I will look specifically from AFM perspective rather than looking at it from an overall perspective, because respective faculty would have done a good job. Because respective faculty would have done a decent job, I guess, of doing their part. So I will not involve myself in other people's stuff. I will more focus on AFM. Okay, so this is first what we're going to look at is case study 7. This is page number 75 of the ICA's latest case study. This thing. Good. Okay, great. So as we have been telling right from beginning, it is counterintuitive. Don't start with the case, start with the question. So first, let us look at the questions. And I have already pre-highlighted what are the questions with respect to AFM chapter, AFM subject. So first one is about strategy. So that is, SCMP and SM. Then second one is also about SCMP and SM about competitive advantage. Third question is about kind of horizontal or vertical integration and all of that. That's also again SM. Fourth question is about AFM. So let us look at the fourth question. In context of M&A, which financial metric would be most relevant for assessing the potential value of CI as an acquisition target? So CI is there's a company in this particular thing, and what kind of method should we use for valuing this particular kind of company as an acquisition target? So now let us go back and have a look at important text. Okay. So in this, you should know what is, I will not be reading the full case study. I'll be reading only the relevant portion. So it is among India's top business houses. The positive influences life of 1 out of 5 aspiring villagers. The group enjoys trust. All this is just story to build a global enterprise. All this again story. One of the current group company, Connect India. So this is the company entered telecommunication in 2002, leveraging its resources. So they did a lot of leverage. They embarked on an ambitious journey, and a lot of that. Their accent was promisance was marked by innovative marketing. They gave a lot of stuff. The approach was tapped into aspiration of merging middle class. They had a profound impact on competition. The aggressive pricing, see here. From here starts the real story. The aggressive pricing and service package introduced forced competitor to rethink. In response, they had to lower their tariffs. CI faced intense competition from other players like Dtel, M4, and ISL. Despite their efforts, many competitors struggled to keep pace with their innovation and expansion, leading to reshuffling. In 2010 Spectrum auction, they secured 3G license for 3 cities, it's 57 billion. By leveraging technology in 2011, they improved quality of 3G. They signed a multi-year service agreement in wireless network of 120,000 kilometers of fiber. The arrangement was smooth business until 16. This is where again it starts, which struggled to pay the dues, post which they struggled to pay the dues. So you have to understand that it is basically there is something to do with debt. This was seen as an effect of Connect XG. Connect XG is another company. Our company is CI. Okay, that disrupted the industry with its aggressive pricing after its launch in 16 that affected all leading players. By 16, the company discontinued CDMA, migrating subscribers to GSM and LTE network. Same year, they acquired DigiCable, India's largest cable network, integrating new entity called Connect Digicom to bolster it so and so. They also acquired System Sure, Teleservices, and so on and so forth. CI announced a merger with FreeCell, expected to help repay $250 billion of debt. Despite approvals, the deal fell through, meaning deal did not happen. When you say deal fell through, it means deal did not go through. The failed merger exacerbated means spoiled or further deteriorated financial distress, leading to redundancy of employees and discontinuation of voice services. Their problems worsened when it couldn't pay Startel under a managed service agreement. Startel took them to NCLT to recover 12 billion, which led to insolvency proceedings. So everywhere you see, the company is under deep distress. Okay, there's a lot of stress, there's a lot of debt. The company struggled to meet its financial obligations, might have a temptation to manipulate financial, might have led to a temptation. Okay, despite its start, the journey was fraught with challenges, ultimately led to decline. Competition from existing and new players eroded their share and profitability. Additionally, company grappled with substantial debt burden. Again, same thing they're repeating, debt. To alleviate financial pressures through strategic partnerships and merger attempts were thwarted by regulatory hurdles and internal disagreements. In 2019, they succumbed to financial loss, filed for bankruptcy. This marked the end of a once promising venture. Then, all these are there. Let us see what else are there. by 2020, a consortium of companies bid over 250 million for assets, but ultimately ConnectXG acquired them. So ConnectXG is their biggest competitor who launched the course for 3,700 crores. This was part of XG's broader strategy to consolidate. As part of this expansion, they acquired the right to use spectrum for high-frequency bands on April 2020, make an upfront payment. In previous 23-24, they transferred part of the spectrum for a consideration of 300 crores when 17 years was still remaining. After this was sold, the news in the industry that Moonlink was interested in buying spectrum sold for a whopping amount of 900. However, Moonlink got embroiled in a legal battle. So nowhere they've given any other information with respect to financials. So in this kind of a company, what do you think is the way to value? Any idea? Any thoughts? Logeshwaran, any thoughts? Debt to equity? No, debt to equity is not a valuation technique. It is a ratio that you use to see whether the company is doing well or not. It cannot be used to value. Valuation metrics are something has to EV by EBITDA or price to earnings or EV by sales, book value, things like that, residual value, things like that. So here the answer is it ROI? ROI cannot use to value a company. Debt to equity cannot use to value a company. PE can be used to value, but this company is under losses, so PE cannot be used. If EBITDA can be used to value. Why is EBITDA can be used? Because where the company has high amount of debt, or where debt is a very significant portion of the overall P&L of a company, EBITDA is the right metric because EBITDA ignores the interest impact and it values the company at an overall level. So you value the company using EV by EBITDA multiple. Okay. So thankfully, in this entire question, there is no discussion about the financials. Had there been discussion about financials, we'll probably have to think through multiple times. Okay. This is question number 4. Then question number 8. Evaluate the effectiveness of valuation techniques in acquisition of Connect India by XG. So how did they acquire? They gave something here. Acquired these assets for 3,700 crores. This was part of the strategy. As part of this, they acquired right to use spectrum and so on and so forth. So if you look at this thing, somebody acquired. They did not tell you how they acquired. They just acquired them for 3,700 crores. It was their broader strategy to consolidate market position and expand infrastructure. As a part of expansion, they acquired the right to use spectrum. So nowhere are we told in greater detail what is the methodology that they have actually used to value this particular company. But they're asking us, please evaluate the reason or evaluate what is exactly the language that they used. 8. Evaluate the effectiveness of valuation techniques in the acquisition of Connect India Limited by XG. So what are the valuation techniques that you use? Okay. So any thoughts on this? Okay. So one thing is very clear that this particular company is under distress. Okay. So some kind of distress. There is a lot of debt. Now the acquirer would have used techniques that are relevant. Okay, so when you have a company which is not in a going concern kind of a situation, so if there is no going concern, then you do valuation which is relevant to that, or basically distress company valuation. There is this particular entire topic that has been added business valuation chapter. Okay, where they talk about how to value companies that are not in going concern or that have some distress. So what are the various methods that are used in this? You have something called as modified discounted cash flow. Okay, this is the first method. Then you have the DCF plus distress value. Okay, then after that, you have adjusted present value. And then finally, you have relative valuation. Okay, any one of these techniques can actually be used to value the company. So you're required to elaborate on these. You're required to elaborate on these techniques. Let us see how these techniques are, because there is a good amount of description that you have to give for each of them. Okay, let us see. Modified discounted cash flow approach. What is this modified discounted cash flow approach? This method requires coming up with probability distribution for cash flows across all possible outcomes. So you take probability distribution, estimate the cash flow in each period. While computing this cash flow, likelihood of default should be adjusted in conjunction with this cash flow estimate. Discount rates are also revised. So Probability and cash flow, both of them are used. Using updated debt to equity ratio and unlevered beta to estimate the cost of equity. Using updated measures of default risk of the firm to update the cost of debt. Or in case of inability to estimate the entire distribution, probability of distress shall be estimated for each period and used as expected cash flow. So you see here, expected cash flow in a period is cash flow into 1 minus probability of distress. Probability of distress is that the company does not survive. Okay, so if it does not survive, 1 minus does not survive means probability of survival or probability that the company is a going concern. So that is expected cash flow. Okay, now there is something else called DCF plus distress value. What is this? Earlier we said modified DCF. Now we are talking DCF plus distress value. A DCF valuation values a business as a going concern. However, DCF valuation will understate the value if there is a possibility it will fail before it reaches growth stage, and assets will be sold for value less than present value of cash flows. Thus, the value of distress firm, that is CI, can be computed by following steps. Value the business as a going concern by looking at the health of cash flow. It follows back to normal path. So do a normal DCF. Okay. Determine probability of distress over lifetime. So figure out what is the probability of distress. Estimate the distress value as a percentage of book value or as percentage of DCF. So estimate the distress value as percentage of DCF. That is, if distress value, if normal DCF, let's say normal DCF is 100 CR. Okay. Distress probability, let's say, is 50%. Then distress sale value is equal to either 50% into 100, which is 50 crores, or 50% into book value. Okay, current book value is 50 crores or 30 crores or some number into book value. Let's say book value is 30 crores. So then it is 15 crores. Figure out which one is more appropriate. Okay, accordingly, following formula shall be used to calculate the value of the particular thing. What is the formula? Value of equity is equal to DCF value of equity, which is what we found out first, 100 crores, into 1 minus probability of distress. Distress probability is 50%. So 1 minus 50 is again 50 plus distress sale value. What is the distress sale value? We figure out, let's say it is either 15 crores. Okay, why? I said because it is the probability of distress multiplied by the book value, right? So 15 crores. And what is the probability of distress? Probability of distress is 50%. Okay, so you add this 15 crores to this 100 crores. So what you do is 100 into 50% plus 50% into book value, which is, let's say, 30 crores. So you get value of 50 plus 15, which is 65. This is how you value. Okay, is it clear? Yes, fair enough. Let us now move to the next one. Let us now move to the next one. We have finished case study number 7. Now let us move to the next case study. Next case study is case study number 12. So let us look at this case. There are 3 questions in this. Now let us see what is it that they're asking. The EPS of both the companies pre-merger. Very simple question. What is the EPS of both the companies? What is the EPS? They have given some data here. Number of equity shares, market value per share, earnings after tax. It is very simple. This is, they have not given it in rupees or whatever it is. So we just need to directly, earnings after tax means PAT. EPS is equal to PAT by number of shares. Simple. You just go and use that formula, which is 61,000 divided by 30,500, which is what? 2. Then 3 lakh 5,000 by 61,000, which is 5. EPS is 2 and 5. So direct, straight, simple. There you need not, in fact, even read the entire question. Okay, 2 is to 2 and 5. MNO is 2, PQR is 5. Answer is B. Next, PQR wants to ensure the earnings to the members are same as before the merger takes place. The exchange ratio to satisfy this condition of PQR shall be what? So, if you recollect, I don't know if you've taken AFM classes from us, but if you've taken AFM classes, I very clearly explain MNO and PQR. If the ratio of their earnings is 2:5, and if post-merger, there should not be any reduction in earnings, a fair exchange ratio is 5:2. Exactly ulta of this. Okay, so think of it this way. I have one small Dairy Milk chocolate. You have one big Dairy Milk chocolate. Okay, my chocolate is one small cube. Your chocolate has big one, 10 cubes. Now, what is the fair exchange ratio? How many chocolates of my small 1 cube should I give you to get 1 chocolate of yours? Exactly ulta, which is 10:1. Okay, so if I give you 10, you will give me 1 of yours. Even though I have 1 chocolate of 1 small cube and you have a big chocolate of 10 cubes, right? If we have to, there has to be a fair exchange ratio. The ratio which is exactly ulta, which is 10:1. That is, I have to give you 10, you have to give me 1. Okay, I'll give you 10 of small, you give me 1 of big. Okay, if I have small and you have big. Same logic applies here. The answer is the fair exchange ratio is 5:2. Now, what is the question? Exchange ratio required to satisfy this condition. What is it? 5:2. 5:2 is 5 by 2, which is 2.5. The answer is C, 2.5. Okay. If they're given ideally in some ratio, it would have been great, but they've not given a ratio form. So we have to give it as 5:2, which is why you should never get confused what they're saying. Okay. Then, 8th question. Suppose the merger was carried out based on the exchange ratio suggested by A, illustrate the impact. Acha. So now one A has suggested something. What did A suggest? We have to go back and actually have a look at the entire case. Let us go and look. I don't think we need to go through entire case, nevertheless, but I think some elements of the case we need to look at it. MNO has decided to acquire PQR. They prepared a scheme. Offer was made. Offer remained open for 4 months. Offer was approved by 92% of the shares. Subsequently, they gave notice for dissenting shareholders. Such notice was given on August 23. Dissenting shareholders made an application to tribunal that acquisition should not be permitted. Acha, there is this minority shareholders who are fighting. However, their application was dismissed and hence they acquired, MNO acquired balance 8% shares. So here, please note one small thing. MNO is a small company. PQR is a big company. MNO is acquiring PQR. It is a reverse merger. Okay. While other minority have reconciled the discussion of the tribunal, a shareholder holding 5% is furious. He believes that the growth prospects of PQR are higher than M&O, and he believes the exchange ratio should be calculated on basis of market value. So A wants market value. He also believes forcible acquisition of shares is a violation of his rights and amount to oppression. All this is again unnecessary information. He wishes to approach the High Court. Okay, no problem. Pre-merger, they had a block of assets of 15% depreciation. After depreciation was, after reducing depreciation, it was 4 lakhs. It was purchased for all of this is book value. Is it relevant for us from a AFM question perspective, book value? Because this question is very specific, market value. So let us see. Is there any other information? The company shall elevate CFO, COO, and all the overall cost of capital. All of this is irrelevant to us. What is the market value? Straight away come here. What is the market value? Market value is very clearly given. 22:110. If it is 22:110, the ratio is 1:5. Exchange ratio of market price is 1:5. Exchange ratio should be 5:1. Exactly ulta. Whereas, what is the exchange ratio as per EPS? We just now computed 2:5. That is ulta of 2:5 is 5:2. M&O is acquiring PQR. M&O is acquiring PQR. For every 2 shares of PQR, the ratio is 5:2, right? So for 2 shares of PQR, the shareholders of PQR got 5 shares of M&O. This is what 5:2 means. Now, what does 5:1 mean? For every 1 share of PQR, they should get 5 shares of M&O. So this ratio is exactly double. This ratio is exactly double. Instead of getting 5 shares for every 2 shares, they need to get 5 shares for every 1 share. They need to get 5 for every 1. What they got for PQR was for every 1 share of in this old ratio, which is the ratio of EPS, for every 2 shares of PQR, they got 5 shares of M&O. So I give 2, I give 2 and I get 5. This was the old ratio. What he is suggesting is I will not give 2, I will give 1 and I will get 5. So he is saying I will give lesser shares and get more shares. Whereas the old ratio is I will give more shares and get lesser shares. Okay. So it is not extra share, it is giving 1 share less. Okay. Now this is what he's saying. Now what is the question here? When you come back to the question, suppose merger was carried out based on the exchange ratio. Illustrate the impact of the merger on EPS of both the companies. If you do it as per the PQR method, or rather what A is suggesting, what is the value of the, what is the EPS of both the companies? So why are they saying both the companies? Because shareholder of PQR and shareholder of M&O both are still existing. Okay, so let us see what happens. I need not solve this. It's a very simple question, which is why I'm not solving this. I can directly show you the answer and explain it to you. Okay, so for 5 shares of M&O, for 1 share of PQR, which is what I was telling you, instead of for 2 shares of PQR. Now, after merger, what is the EPS of both the companies together? both the companies together, profit is 61,000 plus 305,000, which we saw earlier itself. 61,000 plus 305,000. So this is the profit. So combined together is the revised profit, which is 366,000. 3,66,000 is the revised profit. 3,66,000 is the revised profit. But what is the new share count? New share count as proposed by Mr. A is for every one share of PQR, he wants 5 shares of M&O. So there are 61,000 shares. So he wants 61,000 into 5, which is 305,000 shares. Already how many shares are in M&O? 30,500. So 305 plus 30,500 makes it 3,33,000, 35,500. This is the total revised share count. So revised profit by revised share count per share EPS is 1.09. Now you see 1.09 is the per share revised EPS. This is revised EPS for the combined company. What are they asking? They are asking what is the impact of old shareholder of M&O, old shareholder of PQM. Now, old shareholder of M&O, the smaller company, M&O, which is the acquiring company, he was earlier getting an EPS of 2, correct? Because his profit was 61,000, his share count was 30,500. So EPS was 2. Now what has happened? He is getting, his share count is same 30,500. He was holding earlier 1 share, now also he's holding 1 share. So for that 1 share, his EPS is 1.09. So from 2, it has fallen to 1.09. So this fellow has lost 91 paisa. Who? The smaller company, M&O, not the company of A. A is from PQR. PQR will gain. How will they gain? Let us see. For 1 share of PQR, they're going to get 5 shares of M&O. They're going to get 5 shares. They're going to get 5 shares of M&O. Then they, for each share of PQR, they're going to get 5 shares of M&O. So 5 into 1.09. What is 1.09? The new EPS of the company. So 5 into 1.09 is 5.45. This is the new EPS of the with respect to the shares that are held by the shareholders of PQR in M&O. Shareholders of the target in the acquirer. This is the share number of shares that are held. What was their old EPS? Their old EPS was very clear. 305,000 by 61, which is 5 rupees. So they have made a gain of 45 paisa. Whereas the M&O, which is the acquirer, has lost. Each shareholder of acquirer has lost 91 paisa. Whereas each shareholder of PQR, the target, has gained 45 paisa. So this is the answer. You understood? Any doubts? Yes. Okay. Let us move forward. This is question number 12. Next, we are going to question number 17. This is case study number 17. Let us look at the questions again directly. How to classify the loan, FR. Then liability, current liability, FR. This is not our problem. Which is true. This is again SCMP or SM. What does it use for model for retail outlets? We don't care. This is not our thing. GST is nothing to do with us. Compute this value of CT, customs duty, nothing to do with AFM. Then 3 choice: forward cover, money market cover, and currency option. Which is preferable by the company? Very good. See, this is AFM. Okay. Then with reference to calculate the customer lifetime value. This is probably ICMP. This is not ours. We can actually see that also. Constructive obligation. So this is also this payment of bonus. This I think is costing or SCMP. This is not related to us. So probably 7 and 9. Okay, 7 and 9. What is this? Company has 3 choices: forward cover, money market cover, currency option. Which of the following is preferable? Compute INR required under different alternatives for buying $1 after 3 months. So you have to read through the entire question. See, for import of the machine. So they are going to import. Okay. Details of exchange rates. Hence, at the time of import, a company entered into forward contracts to hedge foreign currency cash flows without considering other alternatives like options or money market. Details of which are provided below. Spot rate is this. So this is bid, this is ask. Because they are an importer, they have to buy, which is the banker has to sell. So ask quote will be relevant, 80.98 with respect to spot, but they did a forward contract. And they said actual forward contracts commensurate with theoretical forward rates. At the time of entering into bank charges a margin of 0.5 on its buying and selling. So this is an interesting part. So we have to find out forward, then option, then money market. Do you recollect what is money market? You borrow in one currency, deploy and deposit in another currency, and then finally get it and all of that. In AFM, yes. If you recollect, it is great. So this is one. Now let us look at the easiest one first. Always first to finish the easiest one, which is forward contract. What is a forward contract? This thing, interest rate. Interest rate in India is 10%. Interest rate in US is 4%. So the differential between those two. This is for how much period? Exporter in 3 months. So 3 months is the differential rate what we should be bothered about. So 1 plus 10% by 4. Okay, divide by 1 plus 4% by 4. Okay, these two will give you the interest differential or how much the rupee is going to depreciate. So 1 plus 10% by 4. What is 10% by 4? 2.5%. 2.5%. Right, which is 0.0025 plus 1. Okay, 1.025. I'm sorry, not 00, 1.05. And by 1.01. So divided by 1.01. Okay, you'll get some number. This you multiply with the ask rate. Why ask rate? I already told you, because you are going to buy currency. This is the rate. So you multiply this into 80.98 into 80.98. You get 82.182673. Now I'm solving it like this very, very quickly. You cannot solve like this in the exam. In exam, you are supposed to do it in a more detailed manner, proper manner, the way in which you would actually solve. Because if you would solve like what I'm doing, you will not get marks. I will show you the answer in the final case study. But for now, this is what it is. Then you need to buy a call option at a strike price of 81.1 and premium is 1.5. So if premium is 1.5 time of entering foreign, bank charges so and so. And please note plus 0.5%. This is also there into 0.5% is 0.41091 plus 82.18267 makes it 82.59. This is the 59358. So 36 you can take. This is the forward rate. This is the forward rate. Now coming to the we'll come to money market last because it's a slightly detailed working. We'll look at the forward contract. We'll look at the option contract. What is the option contract? Have they given anything else? No, they have not given anything else about the option. They have not said whether the option strike price is achieved, not achieved, nothing. They have not told anything. Right. So they have not said whether the strike price is achieved or not. We'll just assume that strike price is given, but on that day, what is the spot on the future date is not given. So we'll assume that it gets struck. You achieve the strike price and 81.21 is the rate at which you'll get. So what is the cost? 81.21 plus you have this 1.5 which you pay initially. Now, please note this is rupee option. This is a dollar option. So or rather, this is a dollar option. This is an option to buy dollar. This is an option to sell rupee or buy rupee here. Here it's a call option, so it is a buy rupee. So you're not trying to buy rupee. You are trying to buy dollar. So the left hand side, 81.21 and 1.5 is relevant, and this other side is not relevant. Now 81.2 plus 1.5, but this 1.5 is paid upfront. If it is paid upfront, you have to charge interest because you have to compute everything at a future value basis. So this 1.5 into 1.025. Why am I taking 1.025? Because 3 months interest rate is 10%. 1 year interest rate is 10% per annum. For 3 months, it will be 10% by 4, which is 2.5%. So into 1.025, you will get 1.5 into 1.025. You will get 1.5375 plus 1.5375, which will be plus 81.21, which will be 82.747. So you see, option is costlier than forward. Option is costlier than forward. 7475. So you can take 747. Okay, this is done. Now, coming to the final one, which is our money market. What is money market? In money market, I will not explain it like this in the air. I will take you to the solution, and then there we look at it. It is easier that way. In money market, please note, we need to have dollars at the end. So basically, towards the end, we need to have dollars which we will use to pay off our dollar liability. So we need to get dollars with us on the last day. If we need to get dollars on the last day, we need to have deposited dollars to get the dollars. If we need to have deposited dollars, we need to have converted the dollars initially. If we need to have converted the dollars initially, we should have borrowed rupees and converted them into dollars. So the first transaction will be actually borrowing in rupees. So borrowing in rupees. How much we have to borrow, we'll figure out. Okay. So you borrow some amount. How much do we have to borrow? See, we have to repay, I don't know how many dollars. Let us think of it as $1. Okay. Now I am going to get $1 at the end of 3 months with principal, with interest. What is the interest rate? 1%. How is 1%? 4% per annum. So for 3 months, it is 1%. So 1.01 is what I will get. So I need to get $1, but 1.01 should be the final value. That is 1 by 1.01 is what I will invest in a deposit. What is 1 by 1.01? I think they've already given the number here, 0.9901. So I will invest 0.9901. If I invest 0.9901, at the end of 3 months, I will get $1. So why? Because the deposit rate, interest rate on deposit is 1% for 3 months. It is 4% per annum, 1% for 3 months. So if I have to get $0.9901 today, that is on day 0, how much should I have converted, or how many rupees are required to convert that? You have today 80.98 plus 0.5%. Why? 0.5% is margin. So you need 80.98 plus into 1.05 into 1.005. That is, you need 80 rupees. You need 80 rupees. You need 80 rupees 57 paisa, so that when you give 80 rupees 57 paisa, you will get $0.991. So you are borrowing 80 rupees 57 paisa. So you borrow 80 rupees 57 paisa at 10% for 3 months. Now, when you borrow it at 10% for 3 months, what is going to happen? After the 3 months, you are going to repay. So how much will you repay? This 80.5792 into 1.025. 80.5792 into 1.025, which will be 80.5792 into 1.025, which is 82.59. See, 82.5937. 3680, so around of 80. So you are going to repay at the end of the period 82.5937 by initially borrowing 80. Then you're going to get it, you have to repay. You will repay 82.97. And what are you going to do? You are going to get $1 at the end. So basically, in exchange for $1, you are giving up 82.5937. So what is the thing? For call option, it is 82.74. For forward, it is 82.5935. Here it is 5792. Which one is cheaper? 82.5792. This is 57. This is 59. Which one is cheaper? The money market hedge is very, very clearly cheaper. 590974 and 5937. Forward 5937. Oh, I wrote the wrong number here. 5937. My bad. 5937. So 5937 is higher in money market hedge. Forward is cheaper. I'm sorry. I looked at the wrong number. So 582.5909 is the cheapest, which is the forward contract. So you should go with that. Did you understand this? Do you remember the money market hedge concept? Okay, fair enough. Now let us move to the next aspect. Next is in this chapter, is there any other question? Here there is this question with reference to well outed, calculate customer lifetime value per subscriber. So I don't think this is AFM, but let us see what they've done. This is definitely not our thing. PV of revenue, probability of usage. This is SCMP. So we will ignore this. We will not get into this. Next question is, next case study is case study number 22. Case study number 22, which is which page? Yes, this is page number 243. Okay. Now, Again, we will not get into the case. We will directly get into the questions. What are the questions? Let us see. First one, supply. This is all GST, professional misconduct, auditing. Types of business model, again, SEMPE. Survey is income tax. In connection with consideration for Borsar and Dehradun plant by Kapoor Pharma, analyze the following. Which project should be recommended by Mr. Manish? Explain in his opinion will change if coefficient of variation is used. Provide brief information on project explanation under inflationary conditions as would have been provided by Mr. Manish. Then, is there any other question? Automatically, you are required to calculate OE. This has got nothing to do with this. Comment entry would recognize any liability. This is FR. Okay, or FR or costing, I think. Yeah, FR only, probably, yes. So only question number 6. Now, which product would be recommended by Mr. Manish? So let us see what are the projects here. Dehradun and Borsat. Expected NPV, standard deviation. Expected NPV, standard deviation. So looking at it purely from a NPV perspective, I don't know what is the investment here. What is the investment? So they have not said which what is the cost of each of the projects. So it probably is what is the investment made is not known. So they just given the expected NPV and expected what is the standard deviation of the projects. So just based on this information, we are supposed to figure out what is the project that you will recommend. On the face of it, the Borsat plant is giving more NPV. Okay, now have they said whether the risk averse, risk not risk? No, nothing. So on the face of it, very clearly the Borsat plant is the one which is giving higher NPV. They should go with it. Explain opinion will change if coefficient of variation. What is coefficient of variation? Coefficient of variation is your standard deviation divided by expected NPV. So if you come back and look at this, here 1.8, this is what 1.8 crores by 2.44. So 1.8 divided by 2.44. Here the coefficient of variation is 0.73. Then other one is 2.4 divided by 4.5, which is 0.53. Correct. So here, if you look at this, what are we getting basically here? We are getting for the value per unit of NPV, how much is the risk that we are taking? We are in Borsat plants, we are taking only 0.53. Whereas for in Dehradun plant, for getting 1 unit of NPV, we are taking 0.73 of risk. So to come back and look at the answer, SD by NPV, this is the formula, please don't forget. In this situation, coefficient of variation is more important. Why do we say that? 0.73 on the basis project Dehradun plant appear riskier and hence Borsat plant should be accepted. The NPV method is best because NPV is incompatible to objective wealth maximization in terms of value. No, I disagree with the answer of ICI. I think when we have not given full details, when risk is also an important element, should not go by just the NPV. If risk also has to be factored in, then you should consider something like coefficient of variation. Next, about inflation. During inflationary condition, project cost increases in all heads. Okay, everything includes manager, everything increases, remuneration, bonus, managerial personal salary, everything. That's not only the cost and statement of property, cash flows are also affected. Even financial institutions may revise their lending rates. This is very, very important, right? Then under such circumstances, project capital has to be done keeping in view the following guidelines, which are usually followed by government agencies. Make provisions for cost escalation. Various sources of finance should be carefully scrutinized to reference to probable revision in rates. All these could push up the cost of the project. Adjustment should be made in profitability and cash flow projections to take care of inflationary pressures. It is advisable to examine financial viability and revise it and assess the same at reference to economic justification of the project. That is, you examine the viability at all revised rates. Please don't take one single rate. When I say rate here we are not referring to the inflation rate. We are referring to the lending rate. So please evaluate the viability of the project at various lending rates. Right. Then appropriate measure for this is economic rate of return of the project will equate the present value of capital expenditure net cash flows over the life. The rate of return should be acceptable, which is also accommodates rate of inflation. So basically they're saying the IRR should be whatever you get as IRR will include inflation. So including inflation, whatever is the return that you're expecting, this IRR should be that. That is what they're basically saying. Projects have early payback should be preferred rather than delayed payback. Under condition inflation, project cost estimates that are relevant will suffer escalation. They will tend to initiate measurements of cash flows. Either of following two approaches may be used. Adjust each year's cash flow or inflation index, recognizing selling price and cost increase annually, or adjust the acceptable rate, cutoff rates, retaining suit cash flow projection. That is, increase the discount rate substantially higher. For example, normal rate is 15%, inflation is 5%, this is incorrect. It should be 1.15 into 1. It should be 1.15 into 1.05 minus 1. They again, ICA has made blunders as usual. 1.15, 1.05 minus 1. It will be 20.75%. That should be the rate. It is not just simply 15% into 1.05. That is wrong. Okay. So ignore this answer, what they've given in the material. What I'm saying is right. 20.75%. Okay, this is how it has to be done. So this is question number 22. Now we are, case study 22. Now we're going to case study 28. Case study 28, BL Limited. Now, what are the things in BL Limited? They have asked how, first question, again, we directly jump to questions. Don't look at a case study. How can EVA be improved? Operating profits can be improved without investing capital. What is EVA? EVA is what? NOPAT minus cost of minus capital charge. What is NOPAT? NOPAT is your PAT plus your interest and other things, and any other extraordinary or one-time items or prior period items or provisions and all of that, minus capital charge. What is capital charge? Your invested capital into WACC. So NOPAT minus capital charge. Okay. Operating profits can be improved without investing capital. Of course, correct. Without increasing capital, you can improve operating profits by increasing the EBITDA margin or PAT margin and any of the margins. This is correct. Choose projects where additional infusion of capital gives a return that is less than cost of obtaining. Or if you get a return less than capital, then your EVA will drop. This is incorrect. Then discontinue projects where return of the investment yields more than the cost of capital. Why will you discontinue a project that is giving more return? No, this is also wrong. Change the cost of capital to reflect EVA that is favorable. You will adjust numbers. This is also wrong. Answer is very clearly one. You need not even read the question, read the case. Then assess the performance of BL using EVA. Assumptions, if any, should be clearly stated. Analyze the results of EPS and share market information, and evaluate broader performance of BL considering EVA, EPS, and share market information. So they've given some data here. What is the data that they've provided here? PAT, capital structure, then share price. They're asking you to evaluate the performance of this company based on EVA, on EPS, and share market price. So now let us see what is the EVA here. In fact, we can look at the solution. This is a very easy working. That's why I'm going to the solution. What is EVA? PAT, and you add back interest, which is net operating profit after tax. And interest also is net of tax. Don't directly add interest. Interest into 1 minus tax rate. So you get in 23-24, it was 5 crores. Then it improved to from 6 crores. It was 6 crores in the previous year. It improved to 5 crores in the current year. You add back the tax, you get no PAT. Now, what is operating capital? Operating capital they've given here. Okay, operating capital is opening and closing. You can take average 3 and 4, 3.5, 2 and 3, 2.5. Okay, cost of capital, equity, debt, and tax rate. These are also they've given. So you know how to compute WACC. WACC is 40-60. You can take WACC as 40 into 15% plus 60 into 8% into 1 minus 30%. So you can compute it like that. We will see that thing. So here they have solved using opening capital employed, but typically, you can also take average. A lot of places where I have seen they take average, but anyway, they have taken using opening. You can consider opening as well. Typically, people don't consider closing. They consider either opening or average. Then you do WACC. How did we do WACC? I just told you 60 into 15% plus 40 into 8 into 1 minus 30, and same thing 60 into 18% plus 40 into 6 into 1 minus 30. So basically you're adjusting the debt rate with tax putting the weight of debt plus multiplying plus adding to that the weight of equity into the equity rate. So you get 12.48 for 1 year and 11.24 for another year. You just multiply the capital charge, which is 11.24 into 3 crores. You get 33 lakhs. So from 5 crores 70 lakhs, you subtract 33, you get 536, and from 768, you subtract 24 lakhs, you get 743. So these are the EVA values. These are the EVA values. This is the first one. What is assessment? It has generated positive EVA for the second year, but it has decreased compared to the previous year. So even though it is positive, there has been a decline. That is the first part. Then EPS. What is EPS? You do PAT by share count, you get EPS. So if you see for 22-23, EPS was 1200, it has dropped to 1000. So there is a decline. There is a decline in EPS. Now, what about the stock market? If you see NSE 500, in the second year, it was 18,000 versus 20,000. So it is a reduction of 10%. Pharma index, 18,000, 16,000, reduction of 11%. But this company from 30 to 25, the reduction is 16%. So there is a sharper decrease in the share price. So they have created positive value for shareholders. However, EPS and stock market indicate they are facing higher downturn, or basically they are facing headwinds. Okay, fall in EVA is 27%, EPS is 16%, and your share price is 16%. So there is a negative sentiment associated with this particular company. Okay, this is a very, very simple thing. There is nothing complicated in this. Only thing that could be potentially complicated is whether you should take average or closing. I typically take average because the profit is earned over the capital deployed over the year, not just the opening capital. But here they have solved using opening capital only. Then let us move to next one. Next case is case number 30. Again, need not get into any of the case study details. We can directly get into the questions. What are the questions? Performance reporting, not relevant. Board, not relevant. Net present value of the project. What is the net present value of the project? So this is a good question. There are two based on the risk-free rate and based on risk-adjusted discount rate. So based on two kinds of rates, what is the NPV of the project? So that there is probably some cash flow, there is some inflows and outflows. You are supposed to compute that. So this is a detailed problem. This is a very good question. I believe there's a very high likelihood of these kind of questions getting coming in the exam. So let us see what are the details that are given. Or let us see further any other questions. If there are any other questions, we will have a look and then close it. No, there are no other questions. This is income tax, capabilities, potential, all these are not relevant. What is relevant? Again, this is income tax. So only this in this entire question, only this part is relevant. This is question number 30. Part 3 and 4. So what are parts 3 and 4? Let us see. Have they given any cash flow, and any of that detail? The audit, disagreement, lease obligation. Investment. Project of associate company, the risk-free rate is 7%, risk expected is 7%, life of the project is 5 years. So they have cash flows for each of the years. Then they have some taxation issues, principal repayment, all these are all not relevant. These are all personal income tax related stuff, purely from a project perspective. They have investment of surplus fund of 10 crores. From this 10 crores, you can invest it in 2 projects. Investment was to be made in project of associate company. If you invest in associate company, following are the cash flows. Okay. Following are the cash flows. Same cash flows. There is no FCFF and all of that. I thought there'll be a lot of working here. Nothing. Simply cash flows. 250. So you have what rates? Risk-free rate is 7%. Risk premium is another 7. So you have to compare it as 7 and 14. With the two ratios, you're supposed to compute. Have they given any present value factor? No, they have not given any present value things. We have to directly multiply. It is very simple, guys. 250. Okay. Multiplied by 7% present value factor. You get 233. Okay, same way, each of the years, their present value factor, you add up and you get 2443.4. Subtract the initial investment of 1000, you get 1443. This is at what? At discounting factor of 7%. At 14% will be higher or lower. Discounting factor is higher, so present value, it is 14%. Discount rate is higher, so the factor will be lower, so the present value will be lower. So it will be lower than 14,000. How much will it be lower? which will be 997. Why? The same, you take same 14% discount rate, take present value factors, combine all present value of inflows, subtract the initial outflow of 10 crores, you will get 997. So this is the answer. This is a super simple question. There is nothing complicated in this. Okay, 997 and 1440. That is the, yes, 1440 and 997. That's all. Okay, now let us move to the next one. Next is case number 36. This is case 36. Again, here also we will not look at the whole thing. We will directly come to the question. First one, Porter. This is again SM. Stay in comfort, hike. These are SCMPE. Board meeting, again, law. Calculate EVA. What is here? Again, you have to do the whole thing of EVA. Let us see what else questions are there. Which of the following statements should be true? They should outsource cleaning and food service, ignoring the risks. If the cost is less than cost of providing in-house, this is because EVA of the company will be positively impacted despite the risk of outsourcing. Okay. They make an absolute comparison of EVA of one property with that of another, irrespective of difference in scale. How will you do this? This is wrong. Should reconsider the feasibility of operating properties where is negative. This is 100% right. EVA is a measure of risk, measure into account the current purchasing power adjust for inflation. No, there's no inflation logic in EVA. They should outsource all cleaning, ignoring risk. Why will you ignore something? So it is very clearly answer is C. We need not even read the full question. Then, is there anything else here? No, we have to come back and look at this EVA value. What is EVA? EVA is your NOPAT minus your cost of capital charge. What is NOPAT and capital charge? We can directly look at the solution here. NOPAT. What is NOPAT? They themselves have given net operating profit after tax 5 crores. Not NOPAT, net operating profit before interest and tax. So you have to adjust this for tax. So 5 crores, it is before interest and before tax. So 5 crores minus 30%. So this is 3.5. NOPAT is 3.5. Then capital charge. What is capital charge? Directly your invested capital into 8%, which is 1.6. So 3.5 minus 1.6, answer is 1.9. Very simple. Is that the answer? Answer is D. Yes, very simple. There is nothing complex in this. Then what next? That's all. Completed everything. This is like super simple. There is nothing in this. Let us look at this case study 18. No, it is not there in the list, but I'm adding it. Let us look at question directly, then we'll get into the case study. All these are irrelevant to us from FM and AFM perspective. Size variance and all that is again not relevant. Determine transaction price is not relevant. Compute arm length price is also not relevant. What is relevant to us is this. Determine the amount of bank finance available for the company for operations in accordance with proposal given by the CFO. What is amount of bank finance? Let us come back and look. Bank is ready to finance for expansion of the company, but up to 60% of the valuation of the smartphone business. So you're supposed to now value this smartphone business. So how will you value the smartphone business? What have they said? Have they given any way in you're supposed to value? So they've given what is the price per smartphone, how many units will be sold, what are the issues. Yeah, here only case starts. It doesn't start anywhere else. Okay. Bank is ready to finance, property, plant and equipment. This is the investment required. Okay, then risk-free rate, asset beta of the industry. Industry asset beta, you have to lever it for the company's debt equity. Revenue for the current year, NOPAT, market return, then PP is depreciated, sales revenue, the sale revenue and NOPAT will grow at 20% for 3 years. Sales revenue will be stable from third year, fourth year, and incremental capital expenditure will be offset by depreciation. Assets and working capital turnover ratio shall remain constant. Okay, so this is what they've given. Assets and working capital turnover ratio. So asset ratio and working capital turnover ratio. So basically assets is a percentage of sales. Okay, so using this, you have to now do FCFF or CFAT. You basically have to do CFAT, compute CFAT, then compute free cash flow to the firm, right? Why do you need to compute free cash flow to the firm? Because project is going to be financed by debt, right? Now have they given debt? Yes, they have said here debt 60% of the overall valuation. So you either you do FCFE and you take debt, but they've already given 9% debt at 300. What do they mean? Let us see. Let us see what they mean. You will actually be able to understand this better if you look at the solution. Computation of bank finance. What have they done? Opening balance of PPE. How did they take PPE? Originally, it is given 300. Okay. From that, every year, 20% depreciation. So 20% depreciation. But asset turnover ratio has to remain constant. So please note. Balance is 240. How much is purchased during the year? We don't know. We will see that. Why? Sales, what is current sales? Sales is 1000 and your working capital as percentage of sales is 200. And what is the PPE? PPE is 300. They gave initially is 300. So 300 is to 1000, which is your ratio is 30%. So when the sales increases, your assets also have to be 30% of what is the sale value? Sale is growing up by 20% every year. So 1000 into 20% is 1200. 1200 ka 30% is 360. If 360 is the closing asset and your balance asset is 240 after depreciating, you have to buy 120 of fresh assets. That is how you compute. Same logic continues for next 2 years also. After that, your depreciation and capex knock off each other. Same logic again comes for working capital. What is working capital? They have said here very clearly what is working capital. Working capital is 200. Okay, so you take this 200 and by 1000 is the first year sale. They have said here, no, where is the first year sale? Sale for the current year is 1000. No PAT is 200. So we will use the same numbers and use them to make projections. So this whole thing is about projections, which is why I wanted to solve this question. So working capital is 200, 20%. So next year 1200 ka 20%, 240. Like that you project. Now you project it for next 3 years. After that, what do? You take NOPAT. NOPAT is first year is 200. So next year it grows by 20% is 240. 240, 288, 345 and 345 for the next year. After that, it is going to remain stable. That is what they said, right? It is going to remain stable. Is that the exact word that they used? Sales revenue will be stable from 4th year. So, and incremental capital will be offset, capex will be offset by depreciation. So this will be stable over the after the 4th year. So you keep this as revenue. So give this as NOPAT, I'm sorry. And then you have depreciation, which you've already computed here. 60, 72, 86 and 103. Okay. Then you have increase in PPE, which we have computed above. After that, depreciation PPE offset each other. Increase in working capital also we have computed. After that, there is no change in working capital. So you have free cash flow to the firm. This is the free cash flow. Now, this free cash flows, you also have equity beta. What is equity beta, debt beta? If you recollect the formula for equity beta is asset beta into 1 plus D by E into 1 minus T. If you recollect, this is the formula. So asset beta into 1 plus debt equity ratio after tax. Equity beta is equal to asset beta into 1 plus D by E into 1 minus T. Same logic. Whatever we saw earlier, you are just cross multiplying it. If you cross multiply it, this is what you'll get, which is 0.6. How did you get asset beta of 0.6? It is there in the question. You can actually look at it. 0.6. Asset beta of industry is 0.6. So you take this 0.6 into 1 plus 1.5. What is 1.5? 1.5 is debt equity ratio. How did we get debt equity ratio? That is also given here, which is your equity is 200, debt is 300. So 3:2, which is 1.5 into 1 minus tax. What is tax rate? Tax rate is given as 30%. So you subtract it into 1 minus tax. So you will get 1.23. Now, what is cost of equity? RF plus equity beta into market risk premium. So market risk premium is your 10% is market return, 6% is risk-free rate. So you arrive at the cost of equity as 10.92. Cost of debt, what is cost of debt? 9%. They have said is the cost of debt. You subtract 30%, you get 6.3. So you compute the WACC, you'll get 8%, weighted average cost of capital. Now, how do you value the whole company? The whole company is valued at your 140 lakhs for year 1, 168 and 201. So these are 3 periods. And then you have terminal value. Terminal value is you divide 345.6 divided by 8.148, which is your WACC. You get, and then you discount all of them to the present date. When you discount all of them to the present date, you will get 3788. Now here only, bad part in this question by ICA is they themselves have given a debt of 300 and they're asking us what is the maximum permissible bank finance. That's a very, very poor way of asking a question. Nobody asks a question like that, but it is ICA. They will ask all such kind of questions. They themselves give some debt value and then they will say, find out what is maximum permissible bank finance. It is not at all correct. MPBF is more from a working capital perspective. This, they are saying that 60% of the total project cost. What is total project cost? 3788. Of that 60%, which is 2272 lakhs. Whereas in the question, what did they say? The question is very specific. Question may they said 9% debt. How can that be? This probably, this is current equities to debt. This is current ratio, current equity and debt. Probably that is new debt what you can take. Probably that is one interpretation that you can see. But this is the very confusing way to ask a question. Okay, this probably is the current data. What is the additional debt that you can take? Okay, so this is the question. Question number case study number 18. We have solved this question number 7 out of case study for case study number 18. Okay, friends. So this concludes all the questions on AFM chapter or AFM subject across all case studies. In case you have any further questions, feel free to reach out. I'm more than happy to assist. As I said, first read the question, then come back to the case study. It is the reverse logic, ulta logic. That is what works in IBS. Okay. All the very best and do very well.